Hello, everyone. I'm just going to wait a couple of minutes, maybe a minute or two, as people trickle in. Maybe in the meantime, everyone, if you'd like, feel free to comment where you guys are coming from in the chat box. It should be at the bottom there. You could just type wherever you're coming from, and it's just kind of cool to see where everyone attends from. I got some people from Texas, Hawaii. Good morning. Good afternoon for me. New York, Chicago, very cool. I always find it fascinating to see where everyone comes from and see the different audience where, so I've never been to Hawaii, that's pretty amazing, but I'm actually from New York originally. Upstate New York, a lot of New York people. I'm from Long Island, to be exact. Westchester, very cool. Might give it another minute here. Lower Westchester, a lot of Westchester people. Okay, I may go ahead and start it. Seems like the number is stagnant. Hello, everyone. I am Chris Neary. Like I said, I'm from New York, currently residing in Charleston, South Carolina. I am the Senior Acquisitions Associate for PassiveInvesting.com. And today I will be covering securing financing for apartment syndication. Before I start, I just want to say I think it's really cool that you guys are joining this webinar today and spending some time to soak up some information that you might not be well versed in, and I'm going to do my best to supply the information that I have on this topic, and I'm going to keep it can be a very complex topic at times. I'm going to keep it relatively simple. As you can see, there's some talking points here. I might get off track slightly, but just going to go through the various types of financing or debt for multifamily, and we can talk about some other things, but I'm going to try to keep it multifamily based. Obviously, this is Multifamily Investor Nation. I'm going to talk about what agency debt is, the difference between non-recourse and recourse, should you use a debt broker, what even is a debt broker, or go direct, so directly into banks, and just other topics on that, on debt financing or securing financing. So first things first, a debt lender is going to be the number one investor in an apartment or in real estate. So they, not always, so sometimes people will go all cash, and good for them. That's very challenging to do, and most people do not. But when purchasing large multifamily, or any multifamily of that matter, even a single family home, a big part of that is putting a mortgage or debt piece on that, or financing, many different terminologies. So what are the various types of debt? So the first one obviously is right there, agency debt, and I'll just define that. Debt, it's debt issued by a U.S. government-sponsored agency, which you may have heard of Fannie Mae and Freddie Mac. You have CMBS, Commercial Mortgage-Backed Securities. That's just an abbreviation. You have bridge debt. You have life insurance. And those are like the four I'm going to name today, but there's honestly a plethora of other options out there that you may be aware of. But the most common, HUD financing, I see someone writing, yes, of course, those are also agency-backed or agency-supplied debt pieces. So the first one, what is agency debt? I just defined it. So you have those government-backed or government-sponsored agencies is the terminology they go by. So that's typically a lower LTV, and an LTV stands for loan to value. You may have heard of loan to cost, LTC, it's very similar. And typically these are your conventional debt pieces. So when you go out and buy a single family home, you put a mortgage on that house, that is going to be agency debt for the most part. That typically in commercial real estate, like I just said, is a lower LTV. It's usually 60 to 75% of the purchase price. And a lot of times that is a fixed rate debt. So there are two types of rates, right? There's fixed rate, meaning that the number is consistent throughout the hold period or the term of the loan, as well as a floating rate. Floating rate fluctuates depending on the market rates. So in commercial real estate, a lot of times, okay, so to preference this, it depends on the strategy of the purchase of the property. So we, as PassiveInvesting.com, are buying very large assets up to over $100 million and in a single asset. And a lot of times, the type of debt that we will put on a property depends on our strategy for that property. So if it's a very heavy value add property, so say we buy an asset that was built in 1997, this is an actual scenario here. We bought a property built in 1997 this past year, and we decided to put bridge debt on there. And the reason we decided to get bridge debt is because with bridge debt actually covers the capital expenditure as well as the purchase price. And that bridge, it's pretty self-explanatory. It bridges you into getting a more traditional or conventional loan, like agency debt after a certain amount of years. A lot of bridge debt is 3-1-1, meaning 3-year term, plus the option to purchase another year on top of another year. So it could be up to 5 years. And that type of debt is usually higher in LTV or loan to value, roughly like 70 to 85%. Let me get this call sheet up here. Sorry, guys. Here we go. So what is agency debt? I define that. And then what is the difference between non-recourse versus recourse? That is pretty self-explanatory, but recourse debt holds the borrower personally liable, whereas non-recourse means they are not able, the lender is not able to pursue anything other than collateral. For instance, if you put a conventional loan on a single family, it's very easy to talk in single family terms, but if you put a conventional loan on a single family house and you default on that loan, the lender can only foreclose that home. They cannot come after you personally. They will not hold you personally liable. And most of this debt all of the debt that we put on our properties are non-recourse. It's definitely more risky to put recourse debt on a loan, but just because a loan is non-recourse does not mean that it cannot turn into recourse. So you have to be careful there. All debt, of course, has its risks. Recourse is more risky just because they can come after you. But all the debt, so bridge debt, conventional loans, most of that is going to be non-recourse. Okay, and then I mentioned earlier life insurance. So you may wonder, what does life insurance have to do with debt? So a lot of these life insurance companies actually place the capital that they get from premiums into real estate or other types of investing. But a lot of times it's real estate, and they will give bridge debt. It's called life co or life insurance, and they will be lenders to large properties. For instance, past properties that we've just acquired, we have used life co companies. And the beauty of that is when you use bridge debt, they very much want to understand the strategy, and they want to know why you want to do a short-term loan. And a lot of times it's for that heavier value add, or in recent terms or recent years, there's been a lot of lease up organic value add on these brand new assets where there's a lot of concessions or specials to lease that property up to get it stabilized. And a lot of times a developer will sell pre-stabilization, and it makes sense to put bridge debt or a life insurance company. It makes sense for them to come in, get that organic rent growth by burning off those specials that were there to help just fill up the property. You get a lot of organic rent growth, sometimes 20, 30. In Orlando, we're seeing 30 to 35% rent growth in 1 year just based on this strategy. So that's where it makes sense to put bridge debt, and then after 3 years, let's call it, you can go in and refinance, or you can go and sell that property. Okay, so a big question you may ask, and this kind of leads me into, should you use a debt broker or go direct? How are you sourcing this debt? Who is helping you put this debt on these properties? And I can talk personally based on our experience with MyPassiveInvesting.com, excuse me. We tend to use debt brokers that will take a fee on top of the loan, or it's usually a percentage, 1 point or half a point, depending on the size of that loan or the amount borrowed. And I would recommend, or I don't want to say recommend, but the difference is a debt broker gives you a lot more exposure to the debt market or the lending market because they have the contacts in place. So typically, going to a debt broker, they will have their own underwriting of the property with the financials and the story or the strategy of the property, and they will create an OM package or an investor or a offering memorandum package, and they will blast that out to the lending market and get a very large exposure to these debt lenders. And the reason you do that is to get the best terms, right? There's plenty of different types of debt as well as terms that you can get. So obviously the number one thing is the interest rate. Then there is fixed debt, floating rate, like I discussed, as well as some restrictions that some of these might have, like DSCR, thresholds, as well as the big one is having the percentage or loan to value. So the higher the loan to value for the lender, the more risk they have, therefore the interest rate will increase, right? So for instance, if you have a property that we put under contract and we're going to a lender market, they may 95% of the time, they'll give you 5 options of debt when you go to a debt broker. They'll say, okay, you can go to a life co company, you can go agency. Typically, agency will be like 60% at I'm making these numbers up, but 3.5% interest rate for a 30-year hold, as well, or you can go into a life insurance or a bridge debt, and that will be higher leverage. It'll be 70 to 75%. Your interest rate will be even higher, roughly at like a 4%, just because of that higher leverage, but it's just a different strategy plan. So that's where using a debt broker is very beneficial, is just getting exposure, more options. But say you have a duplex that you're buying, so 2 units, and it might not make sense to go to a debt broker, so you go direct. Going direct means going into a bank and asking them for a loan. And that takes a lot more effort. It's a lot more groundwork, let's call it. So if you want to get 30 options, you have to go to 30 different banks. A lot of times they may even say no. When you go to a debt broker, those lenders basically are bidding against themselves, if that makes sense. They know there's other people in the market, and they might give you better terms because they know they're competing against other lenders, if that makes sense. So it just depends. It depends on your strategy. It depends on if you want to use a certain bank, depending on the terms. If your investment is not so debt sensitive, then it doesn't really matter, if that makes sense. And also, there's no fee going direct up front, but there's always going to be like back-end fees. So theoretically, it's very comparable fee-based. And before I mentioned going to a debt broker, they take an upfront fee, or not upfront, but when they close on a loan, they take a point or a percentage of that loan. As the loan gets larger, it's the same amount of work if it's a $10 million loan versus a $100 million loan. So as you get larger for the loan, you can definitely negotiate that percentage, if that makes sense. Please, at any moment, feel free to write in any questions, either in the chat box or in the question and answer. There's 2 different locations to write. Someone asked already, is there a recording available to rewatch later? Yes, there will be a recording. We can definitely help you get that link, and a lot of times it's actually posted on YouTube as well. Something I actually forgot to miss in the beginning, I apologize, is the Multifamily Investor Nation convention. This is something that we do twice a year, and it's usually a webinar based, but this will be our first time ever doing it in person, which we're very much excited about. It's going to be hosted in Charlotte. It's going to be this upcoming June 23rd to the 25th, so it's a 3-day event. You can get your tickets now at this link. We can post that in the chat box or in the question and answer, wherever. There's an early access price of discounted of $500. There's limited spaces, so please go check that out. You can meet the whole PassiveInvesting.com team. We will all be there, me included. It's going to be super cool. There's going to be great people in the industry, including lenders, debt brokers that will be in attendance. So go check that out. I see the link was just posted. As well as I'm going to show you our website here. And there's actually a bio of myself if you want to get to know me. And during this time, please feel free to write questions. So this is our team here. These are the 3 partners. You might be familiar with them. I referenced PassiveInvesting.com a couple times here. Here I am. You can click on me. There is a little bio as well as my LinkedIn post, a LinkedIn link right there. That's a bit confusing to say. Awesome. Perfect. So let's get back to this. Let's see if there's anything that I missed. So okay, this is important that I did not include. So when you get a mortgage or a loan or debt for a property, there are some requirements for that debt, right? They're not just going to give debt to anyone. They need 3 key things. They need, first, anyone that's signing on the loan to be a loan guarantor, it's called, you need to have 3 requirements. And those are a net worth of the debt balance or the loan amount. So say you're getting a $10 million loan for a $15 million property. Whoever's signing on that loan needs to have a net worth of that $10 million. And that doesn't have to be one person. It can be multiple people signing, and of course that will accumulate, so their net worths combined needs to be that $10 million. So that's the first piece. The second piece is 10% of that loan has to be, or 10% of that loan, so $10 million is the loan, you need to have 10% in liquidity at the signing of that loan. So you need to have $1 million of liquid assets, or cash, whatever it is, in order to sign that or get that loan. The next thing would be experience. You need to prove that you have experience doing what you're going to do, or especially in a larger deal, you need to show, okay, I've been an operator, I've been a general partner on X amount of deals, or I've been a limited partner in X amount of deals. This is my experience. This is what I do for a living. And if that's not the case, you can take on someone to fulfill any of these pieces of that loan. So you can have someone that, okay, maybe you want to sign a loan for $5 million, but you don't have that net worth. You can go out and find a loan guarantor that can sign that, and what they do, that person will take on that risk of that note, essentially, as well as yourself, you'd sign it as well. But they would take a percentage of the GP. Now that percentage varies, of course, depending on how much risk and whatever it may be. Just to give a number, it's usually, I think it's 10, 15 to up to 30%. Just depends, again. And it also depends on how many of those requirements they are hitting, right? So if they hit net worth, if they're fulfilling the net worth and the experience, they're going to take a higher percentage of that GP. I do not believe that there's any limitations of the number of signees on the note itself, if that makes sense. Okay, I see some questions coming in. Is that liquidity requirement of 10% standard amount or varies on debt borrower? That is pretty standard for multifamily, so a commercial debt piece. Obviously, it's different for single family, but yeah, that's pretty consistent, pretty standard amount is that 10% liquidity. That's almost guaranteed on every note that you're going to be signing for. That makes sense. They want to see, okay, are you able to cover a percentage of this note in case it goes south, right? This is all for the lender's perspective. They're taking on the most risk because they're giving, majority of the times, a lot of money to invest in this deal, and they're just covering their bases. And I haven't mentioned this earlier. The lender is obviously the largest piece, but to secure debt, it takes some time. So say you do pick a lender, say it's a life co company, that closing, that period of time from picking someone and getting all the documentation required to signing and closing on that loan in order to purchase a property or real estate, it takes anywhere from 45 to 60 days. So it's a long time. It's a very long process. It's, in many cases, a lot of money, and the lender needs to make sure, especially with those 3 requirements, that they are covering their basis. Okay, I think I answered all of these questions here. I had another note just to self to give, maybe people had questions or just what we're seeing in the market today. I can give you some floating rate or debt, bridge debt rates within the past 15 days, just to give you a sense of what we're seeing. I know there's a lot of talk about rates going up, but we haven't really quite seen that just yet. And I don't have a crystal ball. I don't know the stuff, but obviously the Fed is saying that it's going to go up slightly, or there's going to do a couple increases. But just to give you a sense, I was looking at one earlier, and it was a 60% loan to value, or LTV, floating rate, and that rate was a 3 to 3.35%. So that's a 3-1-1, so 3 years plus 1 plus 1. Or, excuse me, there was another option, not a life insurance company, but also a bridge debt option. That was a higher LTV, so the last one was 60%. The second term was 70% loan to value, but the rate was higher. It was 3.5 to 3.65%, as well as floating, of course. And those are also based off of the SOFR curve. So you have LIBOR and SOFR. A lot of, basically everyone in the industry has transitioned from LIBOR to SOFR. So you're seeing SOFR throughout the board. And that's at most major banks, most major, basically debt lenders. And you could just do a quick Google search and see that curve and those trajectories of what they're anticipating. Another very interesting piece, someone may say, okay, why, what are you doing to mitigate risk with a floating rate, right? So when you put a floating rate debt piece on a property, you have an option to buy an interest rate cap. Now that cap obviously fluctuates. Maybe it's 100 bips, BPS, that's just 1%, maybe 1.5%, just depending on how much I think you want to spend. For instance, just giving an example, say we close on a loan that's 3%. We're going to buy every time we, PassiveInvesting.com, purchase a floating rate, or put on floating rate debt, we purchase a cap, interest rate cap. Typically it's like $50,000 for not letting that rate go over 100 BPS, if that makes sense. So that's just another way to mitigate risk, especially with rates starting to creep up. Yeah. I'm not seeing any questions come in here. Either that means I'm boring or I've covered my bases here. So please, I'll let a minute or two go by if you have any questions. If not, I will wrap up here shortly. Does 10% liquidity need to be actual cash deposited into the bank's reserves account or just guarantor balance sheet liquidity? To my knowledge, it's just balance sheet liquidity. It does not need to be a reserve. It's not, okay, here's 10% liquidity, and I will get back to you if that's different, but I'm 90% certain. It's just to show that you have that to help them. You're not boring. Thank you. I appreciate that. Okay. I'm not seeing, oh, here we go. So the questions are coming in both in the chat and the question and answer, so I'm just going back and forth here. What kind of interest rate are you underwriting for an agency refi and a bridge in 1 to 2 years? So usually a refi is a little bit further out than that, especially with the bridge debt, it'd be more 3 to 4 years. Agency debt is lower LTV, so it's a comparable rate to what we're seeing in the market. It'll be, obviously we have expansions to that, we have sensitivity tables, so there's a plethora of that, but that obviously is going to fluctuate depending on the deal size, the strategy, what kind of debt. So there's no specific answer to that, if that makes sense. Could you explain what is CURB and SOFR? So it's actually SOFR. It's just an abbreviation. It's just a trajectory of what the rates may go up to on a floating rate, and you can just type in SOFR curve or LIBOR. LIBOR spelled LIBOR, excuse me. And I can just type those in here. There you go. I hope you can see that. Perfect. A couple more questions. What supporting documents do borrowers use to prove their track record to lenders? Good question. So I only can speak on experience just with PassiveInvesting.com. Actually, a lot of times we go back to the same borrower just because they offer such great terms and they like the product that we're presenting to the debt markets. So it's quite easier once you do it once. Maybe if a lender likes you, it simplifies the process. But just for a track record, you can say, okay, for instance, I'm a partner of a real estate firm. This is our website. These are the assets we have on hand. If you're a limited partner in a deal, you could say, I have, just show them that you've invested in this. Maybe you show them a balance sheet, whatever it may be. It's pretty simple. They'll even tell you. Some lenders might have different requirements than others. So sorry if that's very broad, but if that makes sense, just any simple way to show that you have experience in the industry or past experience with taking out larger debt like this, or any debt of that matter. Is there a way around agency loan for the 5-year experience? I have 15 years, 1 to 4 units successfully. Is there any way around agency loan for 5-year experience? I'm not sure I fully understand that question. Is there any way around agency loan for 5-year experience? Any way around agency loan, meaning are there other options for debt? Yes, I did cover that. I'm not sure if I understood. I'm sorry, but you can definitely email me if I'm not answering these. Great. Again, my email is chris@PassiveInvesting.com. Do the key principles have to be active in the GP other than liquidity or net worth? They are. So the key principles are active in the GP other than liquidity and net worth. I don't think you have to sign. I think you can cover all of the 3 requirements with external users or external assets. Let's call them people. So there's 3 requirements for those debt. I think that you can use other people to cover those 3 bases, if that's making sense. Of course, the key principles are the general partners. It's their company. It's their entire employee base that's doing all the underwriting and things of that nature. I hope that makes sense. Answer that. Okay, perfect. I'm going to end it there. I'm not seeing unrelated. Sorry, I'm in the chat box here. I appreciate everyone joining. Again, if you have any questions that you'd very much like me to answer, you can email me. I hope you found value in today's webinar. Again, we do every Tuesday at this time. And here is that link. It should be in the chat box. I see my email was just put in there. Thank you. Please check this out. It's a great way to meet the team if it's something that you guys have wanted to do, as well as just gather as much information as you can on this multifamily topic. And again, here's simple. Our website's passiveinvesting.com, the same as our name of the company, very simple. If you want to check out anyone on the team, we all have bios. Some of the partners have videos. And another great resource is actually checking us out on YouTube. That's how I learn a lot of things that I don't know about, whether it's self-storage that I don't work on or something of that nature. I find a lot of value going back and looking at old videos and see how much things have changed, and whether that's a discussion on debt or anything of that matter. I see it was just posted in the chat box. So again, I appreciate your time, and I hope you all have a great rest of your day. Thank you.